Imagine a stock market that's rocketing to new heights, yet whispers of a looming imbalance threaten to pull it all down, priced for an impossible level of perfection that reality might never match. That's the stark warning from daytrading.com's head analyst, and it could change how you view your investments forever. But here's where it gets controversial. Is this just prudent caution, or a call to abandon ship? Let's dive in and unpack this eye-opening analysis step by step, making sense of complex financial concepts along the way to help even beginner investors follow along. Published from London, United Kingdom, on November 6, 2025, by Finance Wire, this piece draws from the deep expertise of an investor boasting over 60,000 hours of trading experience and a prestigious economics degree from Harvard. Daytrading.com's Dan Buckley kicks off his examination by focusing on fundamental metrics, particularly the forward price-to-earnings (PE) ratio. For those new to investing, think of the PE ratio as a simple yardstick. It tells you how much you're shelling out today for every dollar of profit a company is expected to earn in the coming year. It's like checking the price tag on a future promise too high, and you might be overpaying for dreams that don't materialize. Buckley's findings reveal a jaw-dropping reality. The US market is currently trading at about 23 times forward earnings, a figure that's significantly higher than the 15 times seen in international markets. To put that in perspective, this creates a massive gap, roughly a 51% difference. When valuations inflate this dramatically, historical patterns suggest that future returns could be modest or, in worst-case scenarios, even negative. It's like betting big on a horse that's already won a few races but might be tiring out. And this is the part most people miss. Buckley points to past parallels where US stocks hit similar lofty valuations, such as the tech frenzy during the 2020-21 pandemic or the infamous dot-com bubble of 2001-02. Since reaching its peak in 2021, the US stock market has delivered a compound annual return of approximately 9%, but before that, it endured nearly a decade of lackluster performance with no significant, lasting gains. Following the dip in early 2022, it took nearly 2 full years for equities to claw back to their previous highs. These examples highlight how extended valuations can lead to prolonged periods of stagnation or loss, a lesson that's crucial for anyone considering long-term holdings. Now, shifting gears to a broader theme, a market bigger than its economy. Buckley's team at daytrading.com scrutinized various indicators, uncovering a persistent trend where global investors heavily favor US assets disproportionate to the actual size of the American economy. This skew underscores the immense pull of US markets on worldwide portfolios and benchmarks, almost like the gravitational force of a financial superpower. Delving into the specifics of this US market imbalance, the analysis reveals that America accounts for around 65% of the MSCI All-Country World Index, a key benchmark influencing trillions in global investment decisions. Yet, in terms of raw economic output, the US generates only about 26% of the world's nominal GDP, dropping to roughly 15% when factoring in purchasing power parity, a way to compare living costs across countries. Even funds marketed as global perpetuate this lopsided focus. Take Vanguard's Total World Stock ETF, VT, a popular choice for diversified investing among institutions and individuals alike. It allocates about 66% of its holdings to US stocks, with a whopping 4% dedicated to just Nvidia alone. As Buckley quips, when one single chipmaker accounts for more in a portfolio than many entire countries, diversification is merely a slogan, not a reality. This raises a provocative question. Is true global diversification a myth in today's investment landscape, or are we just chasing the illusion? But here's where it gets even more intriguing and potentially divisive: the outsized impact of AI. Daytrading.com's research zeroes in on artificial intelligence as a driving force, noting that nearly half of the S&P 500's gains in 2025 are fueled by AI-related firms. We're talking semiconductor giants, massive tech platforms, and infrastructure players, including household names like Nvidia, NVDA, Microsoft, MSFT, Advanced Micro Devices, AMD, and Palantir, PLTR. AI has undeniably captured the imagination of markets and corporate boards, promising transformative changes across industries. That said, Buckley injects a dose of realism. cautioning that while AI could revolutionize operations, think smarter automation in manufacturing or personalized healthcare, investors are flooding funds into the sector as if every company will emerge victorious simultaneously. It's true that AI will transform many businesses and their operations, he observes, but investors are pouring money in assuming every firm will be a winner, and better yet, all at the same time. But that's rarely how innovation pays out. Just look at the dot-com era, where many went under and only a few flourished. This counterpoint sparks debate. Is AI the next bubble, ripe for a burst, or an unstoppable wave of progress? Could overhyping it lead to another era of dashed expectations, or are we on the cusp of unprecedented growth? Finally, in his market perspective, A Measured View, Buckley stresses that his insights aren't a dire prediction of an imminent crash. Instead, they're a balanced evaluation of the current state of U.S. equities, spotlighting potential vulnerabilities when expectations are sky-high. Markets can be wildly unpredictable, but Buckley points out that not every sector is in the same boat. Areas like financial services, healthcare, select industrial companies, and even international markets still boast valuations that better match their real-world fundamentals, offering a potential safe haven for diversified portfolios. As he puts it, U.S. stocks don't necessarily need a flood of negative news to experience adjustment. Even subtle signs of strain can have an effect when perfection is already reflected in prices. It's a reminder that markets thrive on balance, and when they're priced for utopia, even minor hiccups can trigger corrections. For the full, detailed breakdown, check out the complete analysis here. U.S. stocks, great expectations, even greater valuations. About daytrading.com, this platform serves up valuable information and market insights tailored for everyday investors, empowering millions of traders around the globe to navigate the financial world with confidence. Contact Barra James, daytrading.com, james.barra@daytrading.com. So, what do you think? Is the US stock market truly overvalued and due for a reality check, or is this just bearish talk in a bull market? Do you believe Ari's hype is justified, or is it setting us up for another dot-com-style fallout? Share your opinions, agreements, or disagreements in the comments below. We'd love to hear your take.